Good afternoon. My name is Claudia, and I am joined by Tim, Steve, and Anders. We are Team B, and we initiate coverage on Merck with a buy recommendation, a price target of $109, a 22% upside to the submission date of our report. Merck's mission is to save and improve lives around the world, inventing for a better life. 3 pillars support our price target: fast-growing oncology drug Keytruda, fast-growing vaccine Gardasil, and the increasingly successful animal health division. I will discuss the products and corporate governance that provide Merck's competitive advantage. First is Gardasil. Gardasil's 5-year CAGR is a healthy 17%. This HPV vaccine has room for growth, as 97% of the world's eligible population has yet to be vaccinated. Next is Keytruda. Since its approval in 2015, Keytruda has dominated the lung cancer space. Its revenues are expected to be $23 billion by year 2025, making it the world's top-selling drug in history. Both drugs are patent protected to year 2028 and have recently surpassed the performance of competitors including GlaxoSmithKline and Bristol-Myers Squibb. Rounding out our holistic story is the animal health division. In this space, we see expanding sales reaching near twice the global rate. This division will only continue to grow as middle-income countries increase demands for antivirus protections. The best is yet to come for Merck. So, what makes Merck so special? Innovative pipeline progression and global expansion into China. With the industry's largest research program, Merck is finding new ways to use Keytruda in combination and in various cancer settings, expanding its product life cycle through optionalities. Merck is also expanding its presence in China, where the most predominant cancer is lung cancer. Over an 18-month period, Merck's sales in China increased 43%, while competitors are lagging behind at 11%. Merck's corporate governance is another value add. Merck earned 5 stars for social responsibility and is ranked 22nd on the list of 100 best corporate citizens. It was also the first to provide a price transparency report. These accolades set Merck apart from its competitors. This is our holistic story, and now I present Tim for our financial story.
Thank you, Claudia. The income statement tells a story of revenue growth, margin expansion, and earnings per share growth. This is a result of the successful execution of its innovation strategy. Revenues in 2018 were $42.3 billion, up 5% from the prior year, and in 2019, revenues were $46.9 billion, up 11% from the prior year. This growth is driven by all 3 pillars, especially the oncology pillar with Keytruda, and we forecast revenues to be $52.1 billion for 2020. Since 2014, gross margins, operating margins, and net margins have trended upward and are an impressive 70%, 26%, and 21% respectively, as cost-cutting is boosting earnings per share. Common size income statement reveals a 10% reduction in total cost since 2016. There is manufacturing restructuring and AI advancements that should further reduce costs by $1.2 billion by 2022, pivoting Merck as the undisputed leader in oncology. This has led us to forecast a 17% CAGR in earnings per share. Also note that Merck has beaten the Street's bottom line estimates every single quarter for the last 5 years, supporting our holistic story. Now, though Merck's cash ratio has slowly declined, please note its interest coverage ratio, rising from 14.7 in 2016 up to 19.7. Over that same time period, return on equity increased from 14% up to 50%. Combine that with its strong current ratio of 1.32, which is stronger than that of Novartis, AstraZeneca, and GlaxoSmithKline. Merck shows judicious deployment of cash and effective balance sheet management, reducing concerns over rising debt levels as seen with its strong A1 bond rating. Now, Merck's history of operating cash flow is one of consistency in an industry where product lines can lose exclusivity and pricing power. Its strong cash flow displays strength in its operational efficiencies, strategic alliances, and its exceptional portfolio of innovative drugs. Operating cash flow was reported as $6.5 billion for 2017, $10.9 billion for 2018, and $13.4 billion for 2019. This upward trend is very important as operating cash flow is the primary driver of capital financing, CapEx, and dividend payments. Because of its strong cash flow, Merck's board of directors has approved a generous $10 billion share buyback and increased its dividend to 61 cents a share, marking the 9th consecutive year of a dividend increase. In addition, with Merck's dividend yield of 3%, it is a reward for waiting for the stock to increase to our $109 price target. And if you consider that the 30-year Treasury bond is only at 1.7%, 3% looks very attractive. While you're waiting for the capital gain, you can collect the dividend along the way. I'll now turn it over to Stephen for our valuation.
Thanks, Tim. Holistically viewed, Merck's relative valuation is the most compelling in its class. Its forward PE of 13.9 and PEG ratio of 0.7 are major contributors to its number one ranking. This can be seen in Merck's 5-year total cumulative return against the same peers in S&P 500. Merck's CAGR of 13% is well ahead of its peers at only 9%. In turn, we take our 2020 estimated EPS of $7.59 and multiply it by our forward PE of 13.9, resulting in a price target of $106. Now, in our bull-bear analysis, our most optimistic price sits at $130, with a low price at $84, a very attractive upside to downside. Our bullish stance is based on an implied EBITDA CAGR of 3.7%, juxtaposed by our bear case at $84, which is driven by sub-industry growth. Our base case fits comfortably right in the middle at $110. I'll now hand it off to Anders to discuss in further details our financial modeling.
Thank you, Stephen. We forecast Merck to generate significant cash flow on a 5-year 10.3% top-line CAGR, coupled with an 11.7% EPS CAGR, leading to an implied EBITDA CAGR of 2.2%. As we're only concerned with the equity of Merck, we use a 6.9% CAPM-derived cost of equity, using a bottom-up beta of 0.7. Given its expanding pipeline and optionalities, Merck has constructed a wide economic moat, as free cash flow climbs from $10.6 billion in 2018 to $13.6 billion in 2024. The recent decision by management to spin off a new co only reaffirms our thesis that Merck is being undervalued on a fundamental basis. Through some of the parts model, we identify 3 robust segments that define Merck: pharmaceuticals, vaccines, animal health, weighting them by their contribution to sales and valuing each segment using a blended PE of firms within each segment peer group. This results in a $112 price target of $7.59 of EPS, using a weighted average PE of 14.76. Checking our results, we performed a sensitivity analysis and a Monte Carlo simulation. Across varying terminal year EPS and cost of equities, our sensitivity analysis indicates a potential downside of $87 to an upside of $121. These results translate to a 2% downside to a 35% upside from the point of submission. Our Monte Carlo simulation over 1,000 iterations shows a mean price of $116 and a standard deviation of $9.89. Our attractive price target sits within one standard deviation of the mean, and thus we are 95% confident of these results. Merck shows an attractive valuation. Given that cash is king, our fundamentally grounded, free cash flow to equity model is weighted the heaviest. Reinforced using a relative valuation and checked using a sum of the parts model, we arrive at our $109 price target, a 22% upside from the point of submission. I will now hand it off to Claudia to go over our risks and our final thoughts.
Thank you, Anders. Political pressure and regulatory approval slow time to market. However, Merck has extensive experience in the approval process, mitigating this risk. A second concern is price pressure. However, Merck's rising profit margins suggest it is managing this space very well. Gene therapy moves treatment away from drugs. However, gene therapy is in its early stages, and its efficacy has yet to be demonstrated. These risks do not undermine our holistic story that is once again based on 3 pillars of oncology, vaccines, and animal health. Merck's recent announcement that it will use these 3 areas to organize their business further reinforces our conviction in our holistic story. Thank you, and we welcome your questions.
Thank you very much. Great presentation. In terms of corporate governance, corporate responsibility, the evidence that you present is basically some outside of outside evidence of corporate responsibility, Glassdoor, etc. What are the elements that really stand out for you in terms of corporate responsibility?
Sure. So one of the elements that we look for is the board and how it's set up. So in the early 2000s, Merck actually eliminated its staggered board, and that is very attractive for shareholders. So that is one element that we look for. Another thing is executive compensation, and they are in the peer average for executive compensation.
At the recent Drucker top 250 companies, we can actually see that Merck ranked 32nd, which was the second highest pharmaceutical company within this list of 250 companies. Second to Johnson & Johnson, which we see as more of a conglomerate, consumer care. But as you can see up on the display, we have a radar chart. What's cool to see in this, though, is that Merck is not heavily reliant on just one of these 6 aspects. They're very widely dispersed and evenly distributed.
Thank you.
Great presentation. I have a question regarding the sum of the parts model. If you could just turn to that slide. So you have forecasted operating income for pharmaceuticals, vaccines, and animal health. I just wondered if you could walk me through how you developed the PE multiples for each of those segments.
We essentially looked at comparable segment, or we looked at the segments and looked at comparable competitors to each of the segments. So we looked at the pharmaceuticals and we picked out the top players within the pharmaceuticals. That would be Bristol Myers and Sanofi, and we took their PEs and just averaged it out, and basically did that for vaccines, picking out their top competitors there, and animal health, and averaging out PE multiples for each of the segments.
So were you able to find pure play vaccine companies and pure play animal health companies?
I think in the large pharmaceutical environment, all of the competitors really mix in, a relative mix of these segments. So we tried to use firms that were weighted the heaviest in each of the areas.
And especially when it comes to animal health, that's where a lot of the times where the companies were clearly distinct. When you have companies like Zoetis and Elanco.
Thanks.
Nice job.
Thank
you. Does the company have a stated dividend payout ratio?
The stated dividend payout ratio is they're just going to it. It's 47 to 50%, and the current dividend payout ratio is 59%.
Okay, so you referenced free cash flow to equity. Could you just walk me through that?
Yes, absolutely. So with the free cash flow to equity model, we used a 6.9% CAPM derived cost of equity. We checked that cost of equity over an array of methods that range from 6.2% to 8%, actually. From what our research found, a lot of different analyst reports were looking at Merck through this singular lens that is oncology. We felt comfortable looking at it through a more holistic lens, warranting the midpoint we found to be 6.9%. Basically, walking it through to the assumptions, we used a 3-series free cash flow to equity model, 2 time periods in each period. Our assumptions are based on above average growth in all 3 sectors or segments that we identified as the growth pillars of Merck, leading to our $110 price target on the base model of the DCF.
Okay, and the DDM was what percentage of the valuation?
So the discounted dividend model, you're saying? So we didn't think that it was a proper valuation to do that, based on the time of submission was a 2.4% yield of the dividend. So we really saw it as a side bonus on top of the initial model. If anything, factoring it back in with the current $2.44 of the forward dividend, it would only increase our model by $2.
Good answer. What about the return on equity? Discuss why you think that's going up at the rate it's gone up.
So with return on equity, we actually did a DuPont analysis, which reveals the individual components that make up return on equity. And it is clear that leverage is primarily what is driving return on equity. However, if you look at the interest coverage ratio, which has been growing, and it's 19, the interest coverage ratio shows that the debt is not a problem at all. They're effectively managing it, and there's no issue there.
And especially with the NewCo spinoff, we're gonna see Merck put most of its debt actually onto that company, making it even more of a stronger balance sheet.
Okay, good. Thank you.
Thanks. It was a great presentation, and I love the graphics you guys had. Can you turn to the page on sensitivity analysis? So I was just going through that. So the worst case price is 88. The highest price is 121. The price right now is 82. So I mean, you're not saying there's free money here. So what do you think the market is sort of missing, which you're seeing? You know, your worst case price is higher than the current price. So how do you view that?
Well, obviously the coronavirus is putting a huge damp on the market right now. We've seen all of the markets go down considerable amounts. But looking at comparable deals to what the NewCo spinoff is, we identified the Celgene Bristol Myers acquisition as the closest comparable. And in that case, you actually witnessed the Bristol Myers stock dip about 10%, which is in line roughly with what's going on here. It takes analysts some time to determine the new vision of the company. Merck is turning into a higher growth, leaner company, and that's a big switch up from what it previously was. But we've identified the three pillars that are really going to cause that, being animal health, oncology, and vaccines.
Sorry, so you're saying because of the spin-off, the market is getting confused because
It's
mispriced.
definitely one of the major impacts that caught it by surprise, but think of it as a hot air balloon. We're getting rid of the ballast, and we're going to keep on soaring up. You see, from the low point, Bristol Myers shot up almost 40%. We have the utmost certainty that Merck will follow a very similar trend, especially how this is coming from in-house. It's very organic as opposed to an outside acquisition.
Thank you.
Hey, great job, everybody. I wanted to spend a minute talking about the spinoff of the NewCo, or that announcement. Could you kind of walk us through the deal logistics of how they expect that to work, or even some of the thinking strategically behind that?
Yeah, so definitely the thinking strategically. So per Ken Frazier, this is now strategically the correct time for this transaction to happen. The reason being is a lot of the legacy brands that are now being spun off into NewCo, they generated a lot of cash flow, and that was what was propping up the oncology business, which they built from the ground up. So now not only is that built up, but it's thriving. So management now believes that the two businesses separated are worth more than the business as a whole. And that's from leaner operating efficiencies, more focus in the different areas.
And just to add to that, the margin products that are there are low margin in the women's health area. So they're spitting off the low cost margins there.
Have you guys had a chance to look at the deal logistics, or have they announced that as to kind of how that's going to happen, or timelines, or anything?
As far as the logistics go, the deal is to be completed about halfway through 2021. This is going to take roughly 50% of the product portfolio from Merck as it is, and basically, you're going to have this very stable cash flow business that is women's health, their legacy business. Women's health is a growing market. It's about $40 billion in market value, and they have a very good chance at capturing that. But they've also identified this immense opportunity with Keytruda, their vaccines division and animal health, which shows exceptional CAGRs compared to the industry. So what this might do for Merck to make them more efficient will save them roughly $1.5 billion in operating efficiencies. But more importantly, the debt aspect of this, the NewCo is going to saddle roughly $8.5 to $9.5 billion worth of debt. So this is going to drastically lower Merck's leverage and allow them to operate a little bit more leaner. And as time goes on, they've already stated that they want to deleverage even more. So this is a move by Merck that allows them to be less burdened by this debt.
How much of their debt is that 8.5 to 9 billion that's going over there? Like, is the whole thing? Yeah. Do you know?
Like in terms of a percentage of their debt, Merck has $23 billion in outstanding debt currently, but it's laddered. Okay. Roughly $2 billion due each year. They are adequately capitalized to pay down the debt per their. Thank you.
Thank you.
And the winner of the 2019-2020 CFA Institute Research Challenge America's Regional is Seton Hall University from CFA Society, New York.
Go! Let's go!
Go Pirates!
Thank you
Thank you
so much.
so much. Thank you
And
so much.
Congratulations to everybody else too. Even though we didn't get to see everybody else's, I'm sure we all made it this far. So good job, everyone.
Great job. It was just an honor to be here and to be competing with such great competitors.